So before I get to Nifty and the setup, it's very important to understand what we as market technicians, if I may use the word, are really trying to do. Essentially, we are students of history, right? So we're studying history and we're trying to see how that really plays out and repeats into the future. Now, why should history repeat? The reason is that market analysis eventually is a behavioral science. So Elliott wave analysis essentially was the breakthrough in terms of studying the market in terms of a behavioral repetitive fractal that occurred over and over again, which is nothing but a reflection of the herding instinct of the public at large. Now, if that is true, then it explains why the 5-3 structure repeats over time in various patterns on the charts, and why we spend time studying it apart from using momentum and trade setups to confirm what we are really seeing over there. Now, also that allows us to combine, say, the economic science, which is also a social science, behavioral science of the economy. And then when you put it together with the long-term behavioral patterns of the market, you can actually come up with some very interesting conclusions, and which is sort of what I moved into doing after 2010-11. So people who are new to this and are wondering why I'm paying so much attention to macro, Nifty is breaking out to new highs, then that means you are supposed to be bullish, because ek level ke baad teji hona chahiye. It's like as if there's some rule written out there that, this is how it's supposed to happen. When Elliott wave counts allow for room for, price extensions on the upside, downside, expanded flats, X waves, and so many different variations that we have to think about. And when that happens, we really try to put it in the macro context so that we don't really get the big picture wrong. So that becomes an important testing point. Can all this go wrong, and can it have a lag? Yes, if your analysis of the macro context, the liquidity picture is wrong, you will get it wrong. And second is that sometimes these things will play out with a lag, which means in the short term for a few periods of time, maybe a couple of weeks, maybe a month, you could actually end up being wrong if you follow this as a process. But still, the momentum setups can give you points of entry. The only thing is, if you have a different view, like for example, if I say this is a bear market rally, chances are I got out early. I didn't ride it completely because the fear of it selling off would come in. So I turned bullish at 17,000, I get out at 18, and now you're almost touching 18.9. Yeah, that can be painful, but you have to step back and look at the entire context. Now, having explained what we are really doing and why it's important, there's a process to really change from, one side to the other side. If you have to take another long trade, how I do it. And I've explained that in my midday videos in the last 2 days to subscribers over and over again, because cycle investing is always waiting for the cycle, for the right setup. If you miss something, you just wait for the next cycle. You don't have to jump on board in between and then, mess it up because you think you can be smarter than the market, or because a certain level got crossed. So just let's go along with the stop loss. It's nice. It can sometimes look good on a book when you're giving trading calls, and then it can look like your call went right, but there's no guarantee of that. Those calls can reverse very quickly sometimes, and it can all look wrong. And especially for investors, it can go all the more wrong, because if you're taking an investment view simply because a level got taken out without a proper backing of what has changed in the data points, then all the more you get invested fully, and then getting out is more difficult, because getting out of a large investment portfolio is far more difficult than getting out of a trade. So having said that, let's now look at what is happening to the US, right? So now when we study the US from a historical context, simply understanding how the business cycle has behaved in the past. I've tried to probably explain this in different ways, but you have to study the business cycle based on what has happened in 2000 and 2008. The main differentiator though between then and now is that in the interim after 2008, we had QE. So which is why many people who've tried to call the business cycle turn after 2008 got it wrong, because the liquidity impact of QE really can continue to push this thing further and further. And so the normal business cycle in terms of how we expect the yield curve to behave, how we expect the earnings cycle to turn, and how we expect equity markets to behave within the context of bond markets and the yield turns and earnings turns, because that's the entire business cycle study. When does what happen? How much time does it take? And how long should you really wait to say that the worst is over? Because in the sell-off that we've already seen, say to the June lows or the September lows, June in India, September in the US, sentiment did get pretty extreme, often seen at the extremes of a bear market. But if I go back and look at 2008, those type of extremes were reached at least 3-4 times with multiple bear market rallies. So will that be the course of action, or is it that we are done and dusted over here? So that becomes the question, and then you go and look at how these data points worked in a non-QE world. And so my sense is very simple, as I'll go into each point. Unless we really go back to QE tomorrow morning, so much for the talk of pivot and so on. That is the only thing that will not make the cycle behave in the normal steps that we are expecting, this after this, after this, after this, as far as the US is concerned, because that is right now the center of the universe in terms of what we are expecting. If there's any reason for me to believe the Indian market, has downside, it has a lot to do with what is happening around the world, and I don't believe in decoupling. So that's completely not a theory. It's just a dream. If you are dependent on global liquidity and India is being funded in terms of our current account deficit through foreign institutional portfolio flows, if that's the only way we get our dollars to buy our oil and gold, then I think to believe that we are not part of the world economy and can decouple is a fairy tale. Yeah, that would be a fair enough thing to describe it as. So let's not do fairy tales, and let's really come down to reality. If the world goes through a serious correction and a liquidity tightening environment, then India is going to be affected, whether you like it or not, whatever your prediction on India's macros and earnings are. I mean, that doesn't matter at that context. If it did matter, you wouldn't have had Y2K. Because during that phase, India's core economic sectors that had consolidated for 10 years, which was just starting to break out, still went through a deep drawdown simply because the global markets were unwinding. So that's just how it is. That's just history. And that's how I look at the current context. The behavior of the last 1 year's market is, of course, very different now than 2000 in some aspects. But over the last 2-year period, I would say it has multiple similarities, because you have many sectors that are breaking out after a decade, looking like they're starting to do something new. So that's the similarity. The difference is that we haven't seen a 1-year lag between US and Indian markets in terms of what they're doing, and this kind of a divergence. And different sectors continuing to do well in what we are trying to call as a bear market. So that's, of course, the difference, and that therefore keeps making us question the idea, are you in a bear market? I kept questioning it till April. Then I gave up because, well, the reflation trade at least was taking a big breather, and that's simply looking at the dollar and commodity prices. So that certainly was the right thing to do at that point, because some of the stocks within that which I got out of fell a lot. So for me that made sense, but the question is, should we have changed to an all-in bull strategy from 15 to 100? I did turn bullish, but I still have continued to call it a bear market rally. And so that takes us to the context of why and what is happening in the global market. So like I said, in the global markets, unless the pivot is of QE level, okay, it's not going to matter right now. So let's just say, unless the Fed goes back to QE tomorrow morning, okay, all this talk of pivot is really something about 6 to 8 months later, not now. And that also is not the end of the story. So what does the story look like? So history is like this, that, US equity markets continue to do well even as they started to raise rates, except for this year. This year it has reacted very, very fast. And they would do that because, well, the growth was still on, and, certain sectors were still doing well. So raising rates a little bit didn't matter till it mattered. And when it mattered, say in 2008, it was the housing bust. In 2000, the tech bubble just went on even as Alan Greenspan started to raise rates. And then there was a tipping point, as is with all bubbles. Now, once there was a tipping point and the economy started to really slow, it did stop slowing right away. It took first several months of that slowing before the Fed first recognizes that, yes, it's slowing enough and that we need to start cutting rates. So that is the first step, and that is the pivot that people are talking about. Right now, because of the inflation theme, and inflation, while it was mild to high in 2000, this time it is much higher relative to where we've been in terms of the downside. Otherwise, that time 4% was normal. Right now, 4% is considered high and 8% very high. So we did have that, and that is why the Fed is still keeping rates high. And haven't seen significant economic data weakness at a macro level. There may be weakness in housing, there may be weakness in particular areas. Consumption being down, retailers taking a hit, but macro GDP numbers still flat to zero, not deep negative, and so we are still not recognizing that there is a recession in the US. So usually what happens is, when the slowdown gets deeper and you start recognizing a recession, the Fed actually pivots and starts cutting rates. But by that time, once a recession becomes deeply ingrained, it's very hard to turn behavior. You're talking, because again, this is a behavioral science. So you're talking about behavior that was outlandish, going out, spending, buying everything you needed because you were in a lockdown. And so we actually overspending. So there was excessive growth than what would have usually been in the cycle. And now you realize that, oh, there's inflation, we need to cut back, we should spend less. Now the jobs are going away, that's the recession. Then you even more spend less. And so getting people back to a spending mode and getting, the economy moving all over again is a process. In history, it has taken 5 to 6 rate cuts before that happened, and it has taken 6 to 12 months or more before the recession really ended and reversed. So putting that in context, we are not even at the pivot, right? We are not even at the point where we are going to change rates. We are only going from 75 basis hikes to 50 basis hikes, which will go on for maybe another 3, 4, 5 months. And then you'll go to 25, and then you'll probably pause, and then you might eventually recognize a recession. Then the yield curve invert from, an extreme negative, which it is right now. 6 months later, when you recognize a recession, it will invert and start rising. At that point, the market further tanks because it ends up pricing in the lower earnings that come with the recession. And that's when the market bottoms, often well ahead of the actual earnings reversal. So markets get cheap and they reverse. And then the multiple rate cuts have that lagged effect of, getting things to stabilize and then improve. So this is a process. It takes a lot of time. The only way QE worked in the past was you just threw money and asset prices bounced back earlier than they would have otherwise without that help. And so that is why I said that if you're going to allow this business cycle to play out just the way I described it, which is how it played out in 2000 and 2008, then we have like 6 to 12 months of, more to go. Every rally would end up being a bear market rally. Then the market falls again till the point you get a recession, which is when the steepest decline occurs, where the pivot occurs. And then the market start recovering after the pivot. And that's sort of been the cycle. And so if the cycle is to go through the normal behavioral pattern we've seen in the last 2 recessions and recoveries in terms of the business cycle, then we are at least 6 to 12 months away before we get that final capitulation. And the only thing that can stop it is a return to QE. So unless there's an announcement by the Fed that no, we are going back to QE, I think we have a long way to go. And I would not want to jump the gun on saying that the US is going back to QE. Right now, people are just trying to jump the gun on whether they'll pivot, which itself, like I explained, after the pivot can take 6 months at least before things actually start recovering. And after the pivot is when you get the biggest drawdowns also, because the yield curve starts steepening. The market recognizes this is a recession, sell stocks and buy bonds. That's the first trade, and that causes a capitulation. So we aren't there yet. And that would be the point at which I would start considering that is the worst over question. Till then, it should be that every rally is a bear market rally and then a sell-off, irrespective it's made a slightly higher high in India, but not so in the US and other parts of the world. And, you'll go from one extreme to the other extreme like we've done over the last 8 months. Extreme bearish sentiment at the bottoms, then a bear market rally, extreme bullish sentiment, again a sell-off. This will keep repeating over and over again till we are done with this. The opportunity really is to trade both sides of the market. Sometimes that is clean and simple, as it was for a large part of last year. But now it's gotten difficult because the bear market rallies are continuing with negative divergences. I think that is the thing that we are really trying to fight near term. But this is the big picture. Now let's put that in context with what is happening in India. We have broken it out to new all-time highs in the Nifty. We hadn't done that in the Nifty 500, but yesterday it did pierce the October 21 high. So even that has sort of done it. The mid and small caps have not. We are seeing extremes in sentiment. I think I've already written about it, talked about it before. And these are showing that the crowd, as far as the market is concerned, is completely bullish. So we are not in the situation we were at the start of October or at the end of June. End of June was the most bearish sentiment since the previous bear market, and October end was significant enough, short positioning, although the sentiment wasn't at the same extreme, but we were back to, a discount in the futures market, showing some negativity because the US markets had fallen to a new low, but India had not. So those were good points to start out on the long trade. Now we are at the other extreme, and other extreme meaning super other extreme. Last 2 days, the FI longs have actually gone to the highest since 2019 when the election took place. We are seeing a record index futures premium, both at the rollover and even after rollover, 3-4 days now, even till today, 130 points, 140 points during the day, sometimes dips to 110, 120 and then goes back up. These are record data points, never been seen in the history of our market. Some people may say, what about percentage terms? But we are only comparing the current time frame, right? When we are at 18,000. So you can look at it in percentage terms. It's still significant. But in point terms, we haven't really seen this. And so when we're looking at this kind of sentiment, there are a couple of other data points. But rather than go there, my main picture is this. In a up-down market, extreme bullish sentiment is sold into, and extreme bearish sentiment is bought into. And we don't really think too much about this being the start of a bull market unless all the factors are in place. I don't think India's earnings factor, for example, at a index level or a market level, we are seeing a slowing in earnings. There may be individual sectors or stocks that are continuing to do well, which is different, right? Which is not what I'm really talking about here. So we are seeing a flattening of that. We have seen the recent IIP and GDP data also flatten and come off a bit from the peaks, because we had the impact of the unlock rate, right? A lot of people who had been saving up during COVID have gone out, started to spending, and a lot of travel. A lot of it has gone to hospitality. So you can understand why hospitality stocks did well. People are, the airlines are booked, hotels are booked. So that's where the spending is happening, eating out, restaurants. So a lot of all that. But this all happens. This is all like the pent-up hidden demand and the feeling to burst out from that lockdown. But once that ends and inflation starts to hit, this is what happens, and it's already happened in the US. As people start cutting back on that spending and saving again, and that is what I don't think markets are pricing in. They price in that you'll continue to spend as crazily as you are doing today, and that is sort of what the growth and valuation perspectives end up building into price. So I would really that's what consolidations are all about, right? That's the waiting period to see whether what you're extrapolating into the future really happens, and that too without the risk of what is happening around the world. Because whatever I've said about the world, if that really plays out in terms of the US, then what will be the impact of that on psychology, sentiment, and eventually the economy? Because even our economy, let's say that Indians will keep spending, growth is on. But what percentage of our economy is exports, right? So if the US and world is affected, you'll say that the exporting side of our economy, China +1 and all, will not be affected. I think it's a really big ball to throw and say, kuch nahi hoega. So I think unless that risk is behind, I'll continue to trade this market as a, bear market, which is extreme bullish sentiment should be sold into, extreme bearish sentiment should be bought into. Even if it's made an all-time high, I'm not going to change that methodology. But there is a way to look at the long short trade in terms of if it pulls back, is it going to go still to higher highs like it did after October? If we get that kind of setup again, sure, we look at the trade on the long side again as I did previously. But will I change my overall stance in the market? That requires many more things to fall into place before you really do that. So this is my take. This is what I've been sticking to. I think about it every day. I speak to people, try to judge whether I'm missing something. But so far it seems to keep coming back to the same idea that we are not missing anything. It's just the market going from one extreme to the other in terms of sentiment, and it's leading to an overshoot on the upside right now. That doesn't really change the picture that when it rolls, we'll again overshoot to the downside. That's the big picture, and that's what you need to really watch out on the Nifty. Where is the turning point? Because when the next turning point comes, we'll have to worry about what is the downside risk from there all over again, which I think most people are now beginning to limit, saying that abhi to iske bhi niche nahi hi jayega. Now whatever that is, the market is always grateful in being able to challenge those things, just like it's challenged the levels on the upside. To presume it will not challenge you on the downside again would be foolish. So that's all on this update from me. Thank you.